Hello and welcome to Switzer Investing Insights, brought to you by nabtrade. And today we want to talk about how hedging can make or break your overseas investment. So Paul, let's kick off with talk about hedging.
Well, I think it's important to realise that when you invest overseas, your total investment return comprises two amounts: the gain or loss in the investment, and potentially a gain or loss on the currency, because you're buying a foreign dollar asset. So let's go just for an example, just to explain that, Peter.
Yep.
Let's assume we bought 10 Apple shares, great company, say about US $300. At the time, the Aussie exchange rate was about 60 US cents, or $1 Australian dollar bought 60 US cents. That would cost 5,000 Australian dollars.
Yep.
Happy with the investment. Apple shares have gone up, go up to say 340 US dollars.
You're a genius.
Yeah, we sell them. Aussie dollar's also gone up to say 70 cents, so $1 Australian dollar buys 70 US cents. We'd only actually end back in Australian dollars with $4,857. So it actually would lose $143.
That's a genius being brought back to ground by the currency.
Yeah, so the security goes up in price, but because of the currency, we end up with less Australian dollars. So hedging is a strategy to neutralise, to effectively take out the currency risk. Now, it's pretty hard to do with individual investments, but with a lot of managed investments such as ETFs and managed funds, you can actually hedge or take away neutralise the currency risk. So some managers actually take on the risk themselves and they run a hedge book. So you don't have to do it. The manager says, I'll take care of it, we'll run it on a hedge basis. Some other managers say, I don't worry about the hedging, that's up to you. For a couple of reasons. Really, that we're just experts in the security, we're not experts in foreign exchange. Some will also argue that over time, it tends to neutralise itself out over perhaps 10, 15, 20-year period. And some managers offer both a hedged and unhedged product version.
Yeah. Now, you've got some charts that look at hedging over time, and they're unbelievably instructive.
Yeah, so let's compare the same investment, and this is we'll look at the exchange traded fund IVV, which tracks the US S&P 500. Probably the easiest way for an Australian investor to invest offshore.
And a cheap one,
very low cost. Trades on the ASX under stock code IVV. That's the blue line. But they also offer a hedged version, IHVV. That's the ASX code. Same underlying index, but hedging taking out the currency risk. And let's look at the returns over 5 years. You can see that over 5 years, the unhedged version, IVV, is up about 60%, and the hedged version is up about 40%. So, and that's largely because over that period, the Australian dollar has come down. So, it's been better to be unhedged than hedged. Let's look at the same two investments over the last 1 year. Still, the unhedged version, IVV in blue, is up more than the hedged version, Peter, in purple. Over the last 3 months, the picture sort of started to turn around. They're about the same. Now, if you think about what's happened over the last 3 months, Peter, the Aussie dollar went down quickly when the pandemic was its scariest, but also had a huge rebound. So over the last 1 month,
and this is the critical one,
if we move on, you can see the hedged version's done a lot better. It's up about 6.5%. The unhedged version, that's IVV in purple, is only up about 2.5%. And that's largely simply a function of the Aussie dollar going up. So while you've been invested offshore, some of your returns you've gone into effectively been lost due to the appreciation of the currency.
Yeah, and it does give you an idea that people who have a view on the currency can sometimes benefit when they decide either to hedge or remain unhedged. Well, Paul, you've emphasised the role of the A dollar. Why has it moved around so much over the last 6 weeks?
Well, it's had a fantastic run, Peter. It got into the mid fives. It's now getting back towards 7. So that's the big figure. So I think there's a number of issues. There's never one reason only, Peter, but let's go through some of the ones that stand out. First of all, Australia's perceived to have handled the COVID-19 pandemic pretty well.
Yep, therefore our economy will be better.
And our businesses are reopening early. So that's a real positive. Our biggest export, iron ore, is in hot demand. Now that's partly a function of growth in China, but it's also a function of what's going on in Brazil and their handling of the pandemic there. Iron ore above US $100, who would have thought that a few months ago?
Good for the budget too.
And that's good for our trade surplus and demand for Australian dollars. Some concerns about both Hong Kong and China. That's probably being more positive for Australia, particularly for international investors who are looking at Hong Kong. They look at a thing called Asia ex-Japan, with a lot of them when they benchmark their investments in this part of the world. the biggest two countries in that are Hong Kong and Australia. When Hong Kong's out of demand, that actually means Australia goes up in demand. So there's some fund flows we're getting because of uncertainties about Hong Kong. US dollar's been weakening a touch, I think generally due to some issues, political issues there. And maybe the Aussie dollar was just too low, and we're seeing commodity prices rebound.
Yeah,
So,
and the point you also make, Paul, if money's coming into Australia running away from Asia, well then they are looking at our great companies, like the CBAs and all that sort of stuff, all the really well-known companies, and the end result was it pushes demand for the Aussie dollar.
it does indeed, and that's why I think we've had such a big rally.
Okay, so let's go and look at this chart that shows you what's been going on with the Aussie dollar.
Yeah, and I think this helps us answer the question about when you hedge. I mean, this goes back to the Aussie dollar over 30 years, and a couple of things stand out. First of all, you can see that we have been in the 50s back in 2000. We also we got there again in, just a couple of weeks ago at about March 22 or March 23, when the height of the pandemic selling. We had a very brief touchdown in the GFC as well. We've also been above $1. That's when the Australian dollar bought more than $1. That was at the time of when it was floated, also back in about 2011, 2012. And you can see how quickly it comes off. But underlying all that, you can probably see this zone between about 70 and 75 cents, Peter, which is highlighted now. A lot of people say that's about the long run average of the Australian dollar. That's about where it should be if everything was equal.
And also what's interesting, Paul, is that 2000 was a dot-com crash. The currency ripped out of that crash. The GFC ripped out of that crash, and we're kind of ripping out of this crash as well.
Yeah, so I think to answer that question, when do you want to hedge? Look, I don't think there's any right or wrong answer, but we can actually take a couple of things out from that previous chart. I think the risk reward favours basically hedging when the A dollar is below its long-term average. Now, a lot of people say that's about 70 to 75 cents. So in the 6s and the 5s, it probably makes sense to be hedging your overseas investments. But, as we've seen, it comes back pretty quickly. So if it goes up, that's not the place to be hedging. You might have to wear some pain. And as we're saying, it can go up for a long time. So I tend to only think about hedging when I think the Aussie dollar is below.
Yeah.
I think there is some negatives about hedging as well. It can be a little more expensive. So IHVV is a little more expensive in management fees than IVV, and sometimes a little less liquid to get set. It's a bit harder to actually buy on the ASX, but that's improving. So I hedge when it's in the downside and then go unhedged when it's in the upside and just take my risk that way.
And I've got to say, working out when you take your hedge off can be a hard one as well, because the people who took it off too early after the GFC could never have believed that the Aussie dollar would go as high as $1.10. But those people who hedged and stayed on it made a lot of money.
Yeah, and they wore a lot of pain. I mean, would probably say if it goes back over 80 cents and I was hedged, I'd unwind it. But as you've seen from that chart, Peter, there's no reason to say it can't go higher. So I think it's a strategy you use. You've just got to use it at the right time and be patient when investing offshore.
Now, great analysis, Paul. That's Switzer Investing Insights brought to you by nabtrade. Thanks for joining us.